the loan officer training with the mortgage calculator. Tonight, we're going to be talking about how to calculate non-employment based income. So we're talking about Social Security, disability, alimony, things like that. So it's income, but it's not from actual employment. So we will go through that here tonight. Remember, we do this at 7 p.m. Eastern Time every Tuesday and Wednesday evening, where we go through a new loan officer training topic. So, our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, will go ahead and break this down for us. So, Jose, if you're ready, we can go ahead and take the chat off the screen, but keep dropping comments there in the chat. Go ahead and drop any questions you have for Jose in the chat as well. You can take it away, Jose.
Good evening, everybody. How are you doing? Yeah, definitely. I'm definitely loving these trainings, seeing the value that we're adding out there to all of our loan officers that are tuning, those that are on our team, those that are going to be on our team, and those that are on other teams that are just enjoying what we're putting out there because we definitely love to share the knowledge, right? We all want to be consummate professionals because, at the mortgage calculator, we train all of our MLOs to be loan consultants. So that's always the goal, and we always want to share that in hopes to improve the industry. So tonight's training is about calculating income that is not based on employment. So it's how to calculate non-employment based income. So let me share the title page with you here. So, how to calculate non employment based income. And we're talking about things like Social Security, disability, alimony, child support, etc. And I'm actually going to give you a great list, a lot more than etc. But just keep in mind what we're talking about here is income not based on employment. So, what types of other income? That's how I strongly recommend you all go to the Fannie Mae Selling Guide and you search for other types of income, and you're going to come up with a section. And it's great because in that section they got all of your links there. You click on each one, like you click on Social Security, and it takes you right there, letting you know what you need to provide for Social Security. You click on disability. In this case, we're talking about long-term disability. Opens it up for you, lets you know what you have to provide for each of those. So, some of the income types not related to employment, the most common ones that we deal with here in this scenario that we're talking about, we're looking at Social Security income, disability, long term disability income, pension income, that's really popular one, VA benefits income, trust income, temporary leave income, also known in some cases as short-term disability. Even though you could be on temporary leave and not be actually have any kind of disability, you could be on maternity or paternity leave, and there's actually coverages for that pay you a percentage of your income as well. Public assistance income, annuity income, retirement income, foster care. That's one that's pretty popular that we get every now and then. Somebody either foster care or they're somebody's caretaker, right? And they receive the disability income payable to them, and then they provide support for their individual. Alimony, child support, right? So these are the most common ones. Now, I guess I could have put in there um, capital gains income, but that's already almost like an employment type income. And I guess we could have put interest income and dividends income. Could have probably added those to this list, those two, because you don't have to be employed to have dividends income from your investments, and you don't have to be employed to have interest income from your investment, right? So add those to your list. I'll make sure to add them to mine but actually, no, let me not mess it up. So so let's break it down here because the whole thing here is first being aware, right? Creating the awareness of what these other income types are, creating the awareness of letting you know that there's guidance out there readily available in the Fannie Mae Selling Guide, and most of the guidelines out there are going to follow Fannie Mae Selling Guides as far as verifying these types of income when you have a full doc application, right? Whether you're agency or non-QM, if it's full doc and you're using this type of other income, the document requirements are pretty much going to mirror the Fannie Mae requirements, and because they're the ones that they make sense. So why reinvent the wheel if it's already there? Same way as when you have a condo and you're looking at condo requirements, a lot of the non-QM guidelines are going to follow the Fannie Mae guidelines as well regarding full review and limited review for condos. Now, keep in mind, sometimes they may vary the reserve requirement. Some will say 10, some will say 8%, some will say 5%, some will say we don't even check it. So that's for non-QM. But getting back to other types of income, you can add the two that I mentioned there to your list. So what are some of the challenges that we face when verifying other type of income, right? Because we don't have the traditional, it's not earned. You don't have pay stubs. There's no job contract per se, an employment contract. It's not employment income. So, I mean, and in some cases, there's other challenges. So, what we're facing here is a couple of basic points. Now, these challenges you're going to face are pretty much going to be, you can extrapolate them to the rest of the other income types, and it's almost always going to be the same challenges, right? And the first one that you see there is the documentation must support a history of receipt, right? Whatever documentation being provided needs to support a history of receipt of the income, if applicable, and the amount, frequency, and duration of the income. Now, think about all of that. The borrower needs to be able to document that they receive the income. They need to document the amount of the income that they're receiving, either yearly or monthly. They need to document the frequency of receiving it. Now, if they say they're receiving it monthly, now you're going to need to show monthly evidence or some document that says that's the amount you get monthly. If you say you get a yearly X dollar amount, a document that says you get it on an annual basis and that it matches the amount that you say you're getting it. And the duration of the income, right? How much longer into the future? Is there a set amount of time or is it until you die? Right? There has to be some document there. So think about all of these factors so that when you're presenting a document to underwriting, you don't get caught off guard when they hit you with a condition that you think came from left field, but it may have already been there in front of your eyes when you looked at the initial document before it was submitted to underwriting, because you have to look at the document, examine, and see if that document supports a history of receipt of the income, amount of the income, frequency of the income, and the duration of this other quote unquote income type that we're talking about. That's the challenges, because these income types isn't like a standard wage that you're getting, pay stubs and all that kind of stuff. So, challenge number two, and this is the biggest one, and a lot of times the most difficult one to confirm, depending on the income type. And again, remember these challenges pretty much applicable to all the other incomes types out there. Continuity of the income. That's one of the more difficult ones. And usually the requirement is to be able to document a minimum of 3 years continuance of this other quote unquote income. So continuity, continuity of the income. Think about that one for a lot of things, like for the pensions. That's a big one. Customer says, "Yep, I got my pension," and they even give us like the whatever the 1099 that they give, with the distribution, what they got that year. But okay, that shows you got it this year. And you can even have the one for that showed you got it last year too. But what's the probability that it's going to continue for at least 3 more years? We need something in writing. Either the on there, what you call it, the handbook could have the policies and procedures of the handbook. If we're talking about the or an actual letter, quick letter from the administrator. Yes, uh, Jane Doe is member whatever number, pension plan number whatever, and the plan will pay benefits until X date, or will pay benefits until death. A little morbid, but whatever it is, it is. We just need to document it in writing so that a underwriter can check off on that box. So continuity of income, and usually it's 3 or more years. So on pension plans, that's a biggie, because sometimes these pension plans are just distributions, a distribution for they cashed in some chips, right? And they got a distribution that year, and then next year they cash in some chips, but it's not a real pension plan. Maybe it's just a retirement plan that they're pulling money out of. So a lot of moving pieces here that with the proper documentation, you want to make sure that it's actual income and not a sale of an asset, which would be cashing in some chips as a sale of the asset. That's not income in the sense of the word that you're going to be able to use income. And actually, for that one to be considered income, even if you're looking at continuity of income for at least 3 more years, and having done it, that's a whole other can of worms that you're opening up there. Another challenge of this other income is it actually an eligible income type? Sometimes people think it's income and they're getting money for something, but in the end, it's not employment income. There's not on a tax return, and it can't be documented because maybe it's like border income or something like that. So be very careful on what kind of income types you think you're going to be able to use. And then, the last challenge there, the biggest one in this category because of the unusual natures of a lot of these income types. And I'm going to go back to our income types there because I see a question on disability income, foster income for a minor child, right? That's going to be related to the foster care income category, and really falls in line with continuity of the income for at least 3 more years. All of these things related that way. So when we come back here, and then we see all those unusual income types, and then we're needing to get certain types of documents to be able to prove it, right? Like when you're talking about child support, and the borrower can't provide any type of an agreement in writing that says until when they're getting child support. So at this point, yeah, you may be able to document canceled checks for child support every month, but if it's an agreement between the two of them, and no agreement was ever formally created via either through a separation agreement if they were never married, or through an actual divorce decree where it talks about it, and then sometimes, like I said, there's no divorce, but there is an agreement for the child support in writing, stamped by the courts, and that's your legal document to show until when the child support is due, not that the child support is being paid. So at that point, the borrower can't provide the needed documentation, so now they're out of gas in reference to that income type being able to be considered. Yep, she's getting it every month, or he's getting it every month. But where's the document that says how until when they're going to get it? Yeah, you're assuming the kid's 12 years old. They're telling you, yeah, they're going to be until at least until they're 18. But where's the document that says that? So at that point, I mean, I'm not an attorney, so I'm just letting you know what the guidelines say, that you need some document to state until when it's going to be paid. And that's another thing that can be a challenge on the pension plans as well. Nobody can provide anything in writing saying there's going to be available for at least 3 more years. Not gonna happen. So let's talk about now. So we got the challenges of other income verification now. What are some of the solutions? And these are obvious, right? But I like, a lot of times you have to restate the obvious. So for our one biggest challenge there of being able to document receipt of the income, what are some of our solutions when facing other income, other quote unquote income, and you got to document receipt? Well, these are all, again, you can go and extrapolate this action plan here to most of all the other income types, because this is what you need. It's always going to be about show me the paper that says until when you're going to get it, and or show me the money that shows that you're receiving that income every month if you're supposed to be receiving it on a monthly basis, or every year if you're supposed to be receiving it on a yearly basis. How do you do that? Well, it's pretty obvious. A bank statement confirming the direct deposits is probably going to be bank statements, because they're probably going to want to see more than 1 month. For example, for child support or alimony, besides the court decree, you got to show at least 6 months receipt of the income into your account, because that income is not put on your tax returns anyhow, right? So that's straight out of the Fannie Mae guidelines right there. That says 6 months. I happen to remember that one. But so in that case, bank statements confirming the direct deposit, canceled checks from the payer's account to the borrower, copies of the bank statements showing the regular deposits of the funds into the account, court documents. And what I mean by court documents, well, if it's a divorce, some alimony payment, there has to be a divorce decree. If it's child support, there has to be possibly a divorce decree, marital settlement agreement, or a separation agreement that stipulates amounts being paid, stuff like that. Any type of legal document that would be expected for that type of a situation would have to be provided to document the amount that's supposed to be received and until when that amount is supposed to be received. And then if you're talking about pension plans, trusts, right? That's a tongue twister. Or annuities, you need documents from either from the plan provider, like from the workbook that they give, the employee workbook they give you when you got the pension, the trust, or if it's the annuity that's an investment, there should be some type of a document that spells out what type of distributions you're going to get, until when it's valid. Is it a 10-year, 30, whatever it is. And worst case scenario, there's no handbook or actual contract that stipulates what you need. May have to be actually something in writing on the letterhead from the plan provider and signed by somebody. I don't know if they're going to accept an email, depending how that email is formatted. If it looks like a letter and that's all they're going to give you, and underwriter accepts it, that may be okay, but you need something in writing from them, whoever they may be, the plan administrator, uh, documenting that it's going to continue for at least 3 more years, and the amounts. Actually, in this case, we're talking about amounts. Continuity is the next slide, but it's the same thing. Documentation of the amount and the plan and all that good stuff, because it's all tied in together. You're going to need documentation for both the amount received and the continuity, because these are solutions for documenting receipt of the income. But then in our last slide, I share with you solutions for continuity of the income. So again, I was mentioning pension. We're going to be documents from the plan provider. Alimony income and child support income, copy of the divorce decree or separation agreement that indicates the monthly payment amount and the period of time over which it will be received. Critical component there, you got to have that, all of those components, or else you'll keep getting hit for conditions. And social security income, that's usually the easiest one. Sometimes our borrowers lose their docs, but they can go and they can reach out to social security office and they can get it. So you just got to let them know ahead of time you're going to need it when you're pre-approving them. Make sure that they have it. If they don't have it, so they can request it. So by the time you need it, you have it. Because we're talking about the awards letter. They usually get the awards letter at the end of the year, at the beginning of the year for that year. So if it was 2024, maybe at the end of 2023, at the beginning of 2024, it say, hey, this is your Social Security benefit for 2024, X dollar amount per month, and that's it. Good to go there. But you got to have the awards letter because that's what's going to let us know, hey, that's Social Security income, and it's industry standard that income is yours you until you die, right? Don't have to document until continuity of that income as long as you have the Social Security awards letter. That's critical. Now, disability income here, we're talking about a lot of different things, right? So this could be, for example, I had a borrower who, when he finally found a home, I pre-approved him. The wife was just getting, hey, she's pregnant, little belly, I don't know, 3 months, 4 months, and then my wife started showing him properties, and it took a few months to find the property. So by the time that they found the property and they were getting ready to close, the wife had already had the baby, and he was on paternity leave. And now we're on an active loan application. So now the wife's like, okay, fine, we got the contract. Took a few months, whew, got it done. But here's the contract. Let's go. Okay, threw me a curveball. I'm like, wait a minute, who are these pay stubs from? And he's like, well, but I'm on paternity leave, and that's from the paternity leave provider, I guess, insurance company. It's like a workman's comp or disability leave. It pays you a percentage of your gross income while you're on your paternity leave. So I'm like, okay, throw me a curveball. Got to do a little extra research, do my research, saw what I needed, got the paternity leave documentation to show until when the paternity leave was, got the documentation from the employer showing when he was supposed to return back to work, and got the verification of employment that showed his regular earnings, and we were good to go, right? But that's a type of disability income. So, with that being said, now we go back to the clinical analysis here for disability income. We need a copy of the disability statement from the benefit payer, right, to determine the borrower's current eligibility for the disability benefits, whatever disability type we're talking about, if it's short term or long term, because normally in disability we're also talking about long term disability, the amount and frequency of the disability payments, and if there is a contractually established termination or modification date to the long term or the short term disability. Now, when it's short term, we know we got to prove that they're going back to work in the short term. If it's long term, it's a different story, but you still got to determine continuance of the income uh, for at least 3 years if we're looking at long term disability income. So, I mean, we could go down the list because now I'm going to go to a couple of these other ones. Let me go back to that long list I gave you in the beginning, and if we apply the same thought process that we are applying to everything that we just did. Now, if we look at foster care income, you're a foster parent and you get a certain amount every month per child, and that's your income monthly for you to distribute according to however you distribute for your family, right? The rest is the same kind of math, right? The DTI after figuring out the income number, but the whole key is documenting the income in the manner that's acceptable, to be able to document the borrower is receiving it. Remember, receiving it, the amount, the frequency, right? Continuance, all of the same. And when you're looking at continuance, you're looking at 3 years. Again, same thing. Retirement income could be a lot of things there. Usually, income from like a 401k if they're getting dividends and stuff like that. Same thing, continuance. Annuity income, same thing. Document monthly receipt, frequency, amount, and continuance. Public assistance, same thing. Very important. Public assistance, continuance for at least 3 more years. Temporary leave, we discussed that. That's like short-term disability or paternity leave. Trust income, similar. That's similar to pension income. There, document the monthly amount and continuance. VA benefits, that's like Social Security. That's like there's an awards letter to that, and you can see the deposits going in also every month into the bank. Same as Social Security, you see it going every month into the bank. So, I mean, again, the main thing here is for you to realize the thought process that comes into play when you're looking at solving, documenting the receipt of the income, which is the biggest challenge, and documenting the continuity of the income. So, hope you guys got the message there. This is a really good one because we do get a lot of borrowers, co-borrowers that have this type of non-employment income.
All right. All right. Thank you, Jose. So I don't see any questions, but I do just kind of want to. I just want to touch on something here. So, like especially this is for a lot for the new loan officers too, right? So, Jose, we're talking to a client and they say, "Oh yeah, I get child support." So automatically we know we're going to be using, child support, right? So we pull up the guidelines, type in child support, see what it says we're going to need to document the child support. And at the mortgage calculator, you pull up the CRM, click a few buttons, request those documents from the client. Now, you know you need it, your client knows you need it, your processor knows that you need it, as opposed to just submitting a file and the underwriter has to come back to you. Well, what is this? Oh, well, that's child support. Okay, well, I'm going to need this, and this to document it. Oh, okay, now I got to go ask my borrower to give me this, and this, right? That is what, we need to know, especially after this training, right? Is that, okay, we automatically know we're going to need that. We click a few buttons in the CRM, it's requested from the client, and we're on our way to closing a loan instead of, having all this back and forth and waiting.
Absolutely. I mean, you hit the nail on the head. That's the purpose in all of these back to basics trainings that we're doing is, we're identifying a lot of these scenarios that can catch you off guard. And if you're proactive, and if you look at these trainings we've been doing the last few weeks, if you're proactive and you get your verification of mortgage up front in the process, you need it as soon as you pull your credit, you got the application, you have all these mortgages, they're going to have to be verified, the mortgages are a month or 2 months behind on their reporting to the actual date. Same with the VOEs on the self-employment and on the verbals on the salary buyers, and now doing this kind of stuff for sure. This is all being proactive and just empowering the borrower, for example, and letting them know in the beginning of the process of the application, the laundry list that you need. You're going to get a lot more of a reaction from the borrower in a positive way to get you what they need than if you hit them with a laundry list when they think they're going to be closing, and they're already in their mind, they're already moving, and now you hit them with a list and they're going to tell you, hey, wait a minute, but then I was going to need this before. Why didn't you ask me this 3 weeks ago? Now you start stressing them out because they think that the closing's not going to happen in time, and they got to go back to the seller and ask for an extension. So there's a lot of things that come into play that we definitely want to take advantage. And what we definitely want to do here at the Mortgage Calculator is have our loan consultants be proactive, gather all this docs up front so that when they turn in that file and that file goes underwriting right after intake, we got a slam dunk approval or as close as you can get to it, and then just turn in the appraisal and your updated title work and you close, right? That's always what the objective would be.
Absolutely. All right. I still don't see. Oh, wait. There is one question here. The question is, can they use a disability income for a minor child?
Yeah, that's why when I saw that question come up, that's why I went and I touched base on talking about like foster income. It's similar. Disability income for a minor child is usually going to happen when a parent is getting disability income and they receive it for the child. And as long as that, you have an awards letter of some type, right? And then you can document that that's going to continue as well. And that type of income, you probably need to state that that's going to continue for at least 3 years with you as the person receiving that income for that child. But definitely that can be used.
All right. I don't see any other questions, so we can wrap it up. Great trading there, Jose. Thank you. Thank you to everybody tuning in. Remember, we do this Tuesdays and Wednesdays, 7 p.m. Eastern Time. So we will be back next week with some new topics. So we will see everyone next Tuesday, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Have a great night, everybody.